Welcome to Dare to be Legendary, a podcast brought to you by Diversa Partners. In this podcast, we'll be sitting down with some of the brightest minds in tech, the founders, the visionaries, the entrepreneurs, the executives, that all have one thing in common. They are the leaders of today that are entirely transforming the technology ecosystem as we know it. In each episode, our guests will share their journey, vision, and market expertise with us. They are the ones who dare to be legendary. We're joined by Deep Instinct's Chief Financial Officer, Heather Bellini, and Diversa Partners, Frank Camella. Prior to joining Deep Instinct, Heather was a partner at Goldman Sachs for almost a decade and served as their top-facing technology analyst. On today's episode, she brings us into the world of cybersecurity, deep learning, antitrust laws, and this crazy IPO bubble we're living in. I'm your host, Nicole, and let's get started.
So we're here with Heather Bellini. She's the CFO of Deep Instinct. Heather, thanks so much for agreeing to come on. It's obviously such a pleasure to reconnect and have you on here. And I guess for anyone who does not know who you are, I'll do a quick intro. You're now the CFO of a rocket ship cybersecurity business called Deep Instinct, but prior to that, you were a partner at Goldman. You were their top market-facing technology analyst. Basically, anyone who had ever run a public company or has thought about taking a public tech company public, they have thought about you. They know who you are. They thought about how to impress you, how to get your market validation. And while you were at Goldman, I always like to think that whenever you gave guidance on a stock or an industry, it kind of dictated the market, which is not only empowering and exciting, but it also is probably like an unimaginable amount of responsibility. And you've made this really exciting move to Deep Instinct, which we'll get into, but a little bit more of a data dump on you prior for everybody else. You were a partner at Goldman for 8 years. You covered Google, you covered Facebook, Microsoft. I remember when you did the due diligence on CrowdStrike last year, Unity. Prior to that, as a tech analyst, it actually stretched back into the early 90s with Oppenheimer and Lehman Brothers and UBS, and kind of like from the headhunter's perspective, which will be the only perspective that I'm ever able to give. But you've created this larger than life name for yourself in industry as a top software analyst or tech analyst across some of the more important companies of our generation. And then you get a call from one of those headhunters about a business that's built this really exciting deep learning platform for security. You go meet the founder, Guy Caspi, you meet Lane Bess and the rest of the board. A couple months later, you're now the CFO of Deep Instinct. You change your life, you change your career. Then almost instantaneously, you raise a $100 million round from BlackRock, which was obviously super impressive. And so I'd love to dig into Deep Instinct, like how that happened, the decision to go there, how that round closed so quickly. But before we get into that, maybe we can take us back to like your analyst days. Like I'd love to get your perspective on things like what's going on in the market today. I had listened to like a few other podcasts that you've done or TV spots on CNBC, and it kind of seems like every year since 2015, someone has asked you, are we in an overinflated market? Are valuations too high? When is the bubble going to burst? And I guess the question is, first of all, hello, it's great to see you, but like, what do you make of 2021? Like we're coming off of the heels of a global pandemic. And in that same world, Coinbase was valued more than Goldman Sachs for a few minutes during their debut. So like the stream of consciousness thoughts on kind of what are you thinking, coming out of Goldman into a security business, and the market is still as crazy as it's ever been.
Yeah. Well, first off, Frank, thank you for having me. And thank you to the entire Diversa team, because over the years, as we've communicated and I've talked to other people than yourself at Diversa, it's always been a great experience. So it's my pleasure to be here and really appreciate your all's insight on what you're seeing in the market as well, even from a talent perspective, is always really helpful. But to get started in terms of, kind of what we're seeing, and I'm still asked this a lot today, kind of what we're seeing in the market. We had a board meeting yesterday, and that was top of mind for, again, people like Lane Bess and Debbie Hopkins, who've been active board members. We've got others as well, but just who've been involved with so many successful tech companies over the years. And, again, if you go back to what you said, like 2015 versus today, what's been happening, people have asked a lot of the same questions. Just think of what the 10 years done. I was looking this morning, the 10 years at, just around 1.25%, 10-year treasury, it was almost 3% 5 years ago, right? So what have valuations done? If you're a growth investor, in a low growth environment, you buy, or a low inflation environment, low rate environment, you buy growth stocks. And so you've seen multiples. God, it used to be 10 times revenue was a multiple to aspire to. 10 times is not a high multiple anymore, right? You can get 20, 30, more than that, right? When you're looking at out year numbers. And you brought up a really key point, which is post the pandemic, what you've really seen happen. And we did a lot of work on this when we were at Goldman. We wrote this report called The Future of Work. And a lot of it had to do with across software, just the acceleration in trends that you were going to see. By the way, a lot of these trends were going to happen anyhow, whether it's e-commerce trends, whether it's the use of things like Zoom. So you don't have to, we used to fly to Singapore and back to go to meetings, right? And do like a 2-hour meeting and come back. It's kind of crazy. Now you would do that over Zoom, but you've seen these trends just really accelerate as a result of the pandemic, digital advertising, and the one that I'm involved with now, cybersecurity. So, it is a place where, there are bad actors looking to make money off of companies, to go after our critical infrastructure, to go after your ability to transact at your bank, or to, impact a supply chain of a food distributor or energy. And, you've seen that accelerate because now so many people are working remotely. The number of endpoints and them not being on the official corporate network has obviously exploded. And so, I think every day there seems to be another ransomware attack. And so, that's the market that I chose to get involved with. And we could go into that if you want to. But again, what's going on in the market today, I think, is really just a continuation of a lot of these trends that were going to happen anyhow. But it's just been, turn it to 11, if you will, from a Spinal Tap analogy, in terms of how quickly some of these trends have actually taken hold.
Yeah. And so you're seeing the 10-year as a correlation to why Klarna is raising at a $46 billion valuation, and Stripe's going to be this monster IPO, and some of the other activity.
Yeah,
it's a data point, maybe not direct.
It's a data point for just valuations. If you've been doing this for a long time, you look at valuations today and you say, God, they're so much higher than where they were back in 2000. Go back and look at rates were in 2000, right? And compare them to where they are today. That's one of the key factors. But the other key factor is these technology companies, you mentioned a handful of them that are expected to have very strong initial public offerings. And we've obviously had a large number of successful initial public offerings over the last, 1, 3, 5, even 20 years. But that's happened because as the world has moved online, this whole digital transformation trend, and I think this was really probably coined the best by Mark Benioff, where he saw this, in my opinion, happen first, where this trend to digital transformation means that everybody's business needs to become and embrace software. And so, for me, I'm just lucky to have always spent time in a market where there's very good growth tailwinds. And the ones that are able to execute on this successfully are the ones where you're seeing the multiples really expand. The backdrop from a macro perspective in terms of what's going on with rates is a tailwind to how high your multiple could get. But what people are really paying for today is they're paying for that 5 years, even 10 years out, and trying to extrapolate, where these trends could be and discount that at what now happens to be very low interest rates to today in terms of what revenue could look like. And they're applying very healthy multiples to those end markets.
Yeah. And like in terms of, companies finding, alternative, areas to enter the public markets, like what's your opinion on SPACs, no SPACs, direct listing, go traditional. We're starting to see some of the fallout, but also some still very successful direct listings and SPACs.
Yeah, I've seen the debate. I've heard both sides of the debates. And I think for different companies, there's a right option for every company to enter the public markets. For us at Deep Instinct, we're focused on, probably the traditional IPO path versus direct listing or versus a SPAC. But, when you're making that decision, it could also be related to whether or not you're a household name. Cybersecurity companies aren't household names for everybody, but for a company like, I have no idea what Stripe's looking at doing, not involved there at all. But my point is you've got some of these other companies where the brand is so strong, you could see why it might make sense for them if they were to choose that path, right? And there's also different issues right now about whether or not you need to raise. You're going to actually raise primary, you're going to sell primary shares and actually collect, bring cash in versus whether or not you're already so well funded you don't need cash. So that might be another consideration. There's always the debate of the IPO pop. And, I worked in an investment bank for a long time. And that was one of the things you would always hear people, get upset about if the IPO went up too much. It's not as easy as a process to solve for. You're not solving a calculus equation here. So there's a lot to do with supply, how much follow through there is in orders and things like that. So I think it's not as easy to kind of pick on the underwriters as some people like to do. But that I'm probably a little bit biased given I come from Goldman. So, but again, I think what's good for the public markets is there's a lot of paths to get there. And I think that's the most important thing is that you can choose a path where versus before you only really had one option. And the SPAC route, again, there's been a lot of money raised in SPACs. And I think there's also a lot of money on the sidelines in SPACs, which is good. Like ultimately, you want more public companies. If you're, if you're trading in the stock market, you want to have a lot of choice. There's less than 2,000 companies in the Russell 2000 index today. Sounds crazy because there should be 2,000, but there's less than 2,000, right? So over the years, you've had a lot of companies leave the public markets, a lot maybe due to M&A. And you've seen that, you've seen that change. And so I think SPACs is another route. I think, yes, you do have to be, you do have to be careful. But by the way, you have to be careful when you invest in an initial public offering as well, not just a SPAC related deal. So I think good news for me is there's options on all fronts.
It seems to be the case. And one other area that I wanted to get into in terms of just overall broader like market perception is, what do you make of like all the activity in the crypto market? What currencies do you own? Which ones do you want to support today on this call? But it's down, but is it down like it was in 2017? But we're also seeing a lot of institutional adoption across the board. And so is it here to stay? Or if it is, like, well, what does that look like from a time period standpoint?
So I do think it's here to stay. I do think my guess would be there's a lot of regulation that's going to come down the pipe related to this. So, it's an investment that I would say I dabble in, but I just think from a volatility perspective, it's one where you kind of have to, it wouldn't be a big percentage, in my opinion, of our family asset allocation, if you will. But, that also has to do with the fact that being at a private company now, I've got a lot of other exposure to things that have high volatility, to high beta associated with them.
This was news a couple of weeks ago, but it's still pretty current. What do you make of the new appointment of Lina Khan? 46 Democrats, 21 Republicans. It seems like the only thing Congress is able to agree upon is that there's a need for regulation across big tech. What does that mean for technology in general? And just like, what do you make of the appointment? And obviously, she's been a strong supporter of regulation. She's 32 years old, one of the youngest appointees, and obviously could be one of the more transformational ones.
So I think that having someone like her in place that could explain to the government, if you've watched the hearings, whether it's Facebook, whether it's Mark Zuckerberg speaking, or Jack Dorsey, or Sundar, you see that there is a lack of understanding at the government in terms of how a lot of these applications work. So I think one, raising the knowledge level across the government would be something that's helpful for everybody. Again, this is just my opinion. It's hard to go back. And I should say, I have no knowledge of antitrust law. I did spend a lot of time with some very good antitrust lawyers over the years talking about this very thing, not with her appointment, obviously, but just in terms of what it might look like. I was also covering Microsoft as a research analyst when Microsoft went through its antitrust trial as well. And ultimately, I do think it's hard. I mean, by definition, the way we interpret antitrust law here in the United States is that, they basically, they're not charging for the service. And if they're not charging for the service, then who are you disadvantaging? And I think, you could debate that and you could maybe look at, does the way the United States interpret antitrust law need to change? That I think is a real debate. The EU has a different view of what antitrust law might look like or how it's interpreted. They might see things differently there. And so I think, in my opinion, antitrust law and the interpretation of it hasn't been altered here for a long time. And this is probably an opportunity for the government to look at doing something. Regulation isn't great for business typically. Maybe this time will be different if they actually are able to get anything enacted. But I don't want to lose sight of the fact that, one of the reasons why people love starting companies here is because of, for the types of laws that we have, right? So I don't want to lose sight of the fact that, if you look at the biggest tech companies in the world, or just the biggest companies globally, the majority of them are based in the US. And so I have to think there's something about how we raise capital for people and how we're able to compete with people that makes this, I'll argue, one of the best places in the world to start and grow a business into a very large organization.
Yeah. And you bring up a really good point because historically, antitrust laws have been around to protect consumers from collusion and monopolies and price gouging. Now it seems like, to your point, like the larger you are, the more convenience you can offer to the consumer or the end user from, same-day delivery bundled with an entire catalog of Oscar-winning streaming content or like free email or free social media, which obviously like the price is your data, so it's not free. But like fundamentally, like the bigger the big four get, the better it is for the end users like us, like where we have availability to things like social media and email and free delivery or next day delivery. And so is antitrust really protecting consumers, or is it protecting small emerging growth businesses in the tech sector, or really all sectors? And are we kind of just redefining what antitrust really is?
Yeah. I mean, and look, if you go back, I know there's people that have come back and said, Facebook should never have been allowed to purchase Instagram. That was right before the IPO. So I think it was May of 2012. Maybe the acquisition was April of 2012, but they went public. I think it was May of 2012, if I'm not mistaken. And the thing that people kind of forget, if you go back in time, everyone thought that was a terrible deal. Everyone thought Facebook was massively overpaying for Instagram at the time. Now, it ended up being an amazing deal. And sometimes the people that are running these companies, in many cases, are such thought leaders that they see things well before we could see them and well before the government can see that there's going to be harm. And so deals end up getting approved. And by the way, like it wasn't a sure thing that Instagram was going to be as successful as it is, but it's easy to look in the rearview mirror and say that shouldn't have been allowed to happen. But if you go back and read all the press or analyst commentary at the time, I would probably say 80% of the articles you would have written or you would have read would be, God, this was crazy that they paid this much for it. In hindsight, obviously, it was an amazing home run.
So do we break that up? Do we separate AWS from Amazon? I guess we don't know, but that seems to be the direction that if we end up moving forward towards regulation, that we end up going in.
We wrote a piece at Goldman in 2016 talking about the oligopoly in cloud computing, right? So it was AWS, obviously, Amazon's AWS, Microsoft's Azure, and Google's GCP, Google Cloud Platform. And there's other players that compete there, but the three of them have the vast majority of the market share. And I do think if you're the government, that could be something that, again, you could look at the market share that is consolidating there. Again, it has created the whole cloud computing movement has helped companies trade CapEx for OpEx. So it's been really good for business. It's been really good for small businesses. And we're to talk to some of the people that you have as customers, right? These venture capital firms that are looking for people to join their companies. If you were to ask them the cost of starting a new business today versus what it was 15 or 20 years ago, because of cloud computing, the initial cost of getting a company up and running and getting some scale, it's probably come down by 70%, right? In terms of just the infrastructure costs and the time it takes to get a company up and running. Those are all really good things, not just for Microsoft or AWS, but it's just good for the economy, global economy in general. So again, I think we have to be a little bit careful. The other challenge, though, is that it's going to be really hard for anyone else to ever really compete with those companies just because of the sheer amount of capital, CapEx, that they have to spend every year to sustain and grow their cloud network so that they can support all the customers that they have. So, again, what does that look like? If you go back, you could go back to, it was probably the early 90s when we had the telecom, when we had regulation of the telecom industry, really, and you had the breakups. And look what happened there, right? Now you fast forward 20, 30 years, and the telecom companies and the regional bells, if you will, aren't nearly as well, you wouldn't even think of them today, right? So technology evolves. And I do think sometimes we spend so much time trying to regulate the past that we might miss what you should be focused on what are the risks for the next 10 or 20 years to competition and consumers, instead of trying to, right what are the perceived wrongs of 10 or 20 years ago. Because again, what we have learned is the cycle of technology is only accelerating.
Yeah. To your point, it could stunt innovation. If we're breaking up, then what does that do for us as consumers of these products and services? Does it not allow them to go stretch themselves and go start building what the next wave of great software and internet products ultimately end up looking like?
Yeah. The goal, I would think, would be to focus on where the puck is going and not necessarily where it was 15 or 20 years ago. I think if we had spent time regulating AOL, that really wouldn't have done us much good because they're not even, you know what I mean? People were concerned about that acquisition, right? When Time Warner did that. And the market took care of itself. The market took care of them.
Well, regardless of who has the monopolies, who don't, the market is red hot, rampant with opportunities. You had your pick of the litter from not only types of companies themselves, but industries. You could have done something on the internet side. You could have done fintech. You could have done data warehousing. You chose cyber. Why cyber? Why Deep Instinct? Love to get into that decision. Obviously, a long tenure as an analyst. Taking your first private operating role in a fast growth but mid-stage cybersecurity company.
Right. So I got great advice from a former colleague, from Sarah Fryer, who is now the CEO of Nextdoor, which is going to go out via a SPAC that was announced, I think, earlier this week. You guys were involved in her career at some point, if I remember correctly. But I remember calling her last summer and talking to her about some opportunities. And she gave me a great piece of advice. So thank you, Sarah, if you ever are listening to this. And it was, you have to love the product. You have to love the market that you're in. And, I would say we had a mutual boss, a gentleman by the name of Steve Strongen, who was on the management committee of Goldman. He ran global research. And he used to say something similar. He would say, do what you love. And if you do what you love, you're going to do it well. So focus on the things that you love to do. I love technology. I love software. And for me, with cyber, I love the idea of the impact that it could have overall from a societal standpoint. But the other really key point for me was, if you look back at the history of cyber, there's been a lot of cyber companies, and they've come, and they're, kind of, a lot of them are on the back end of growth today. The companies that were hot in the early 2000s aren't the same companies that were hot 10 years ago. And the companies from 10 years ago aren't the same ones that are hot today. And so what I love about cyber is the innovation cycle is short, but it's really steep. And so, you get these 7 to 10 year windows of innovation. And I feel like with Deep Instinct, what I was getting was something that is right at the start of the bell curve. And so again, so for what we do, we are focused on prevention. And so if you look at the evolution of cyber, you had signature-based antivirus. That worked okay for a little while, slowed down people's machines. We probably all complained about it when we would load it onto our desktops or laptops. You had, endpoint protection platforms, and then those got consumed by what now is hot, which is EDR. And, EDR is a great piece of technology, right? SentinelOne just went public. It's an amazing company. CrowdStrike is an amazing company and people that we really respect and look up to. But a lot of EDR in general still relies on remediation. So you're going to get hacked, for lack of a better term, at some point. So we will help you figure out where you were hit and what was infected. Our goal is, if you were thinking of a stack of technology, all of these pieces of technology are extremely important. We think we're the next piece that's extremely important that sits on top of that, because what we want to offer is a way for you to prevent ever having, to have that remediation. So we can stop pre-execution, and this is really important. We stop pre-execution. If you go back and look at the ransomware attacks that hit, the big energy pipeline or the, supply chain of a food distributor or meat distributor just this weekend, right? Like whether it's, what happened with the Quanta attack that impacted a big global tech company in terms of the supply chain of their phones. We can show, and we have shown first of all, our customers would have been protected. So running our brain, what we call the D brain, customers were protected from those ever executing. And that's really important because once something executes, you're infected. It doesn't matter whether you're infected, whether it's 1 second, 1 hour, or 10 days. You're infected the minute it executes. And the deep learning technology that the founders created is just an amazing piece of technology that we've been evolving. Granted, they've been doing it for a while at this point, last 5.5 years. I joined, as you mentioned, in January. But, we think this is where the market's going. Again, you still have people running AV, antivirus-based products from Symantec and McAfee, right? So you're going to have a long tail of security software application providers. We just think we're the tail that you get needed. So, if I were to say we're playing offense by blocking, we want to block things from happening. Not that we won't help you if something happens, but like a lot of the industry prior to this has been defensive. You're going to get hacked and we'll just figure out where you were hacked and tell you where you were hacked, and we'll make sure we stop it and get you back to where things were before. We want to stop that before it ever happens. And the other analogy that works well for this is if you think about, our chairman, Lane Bess, who you know well, was on Jim Cramer's show recently. Yeah, it was great. And so, Lane made an interesting point. He made a point to say to Cramer, he's like, look, think about EDR as being a therapeutic. So if you were thinking of COVID, it would be like the remdesivir of COVID, the EDR. What we're doing in what we see is we're actually the vaccine. We're the Pfizer or the Moderna of cyber. And so we want to protect you and give you that efficacy. And we do that. We not only offer the largest ransomware warranty in the industry through Munich Re, but we also offer you to do this with the best efficacy. So we also have a warranty on our false positives. So we're not doing this while we're sending you a ton of alerts that your securities operations team has to deal with. We're doing this with, it's as fully autonomous as it could be at this point. But when you ask me why I joined, like when I got this pitch from Lane Bess, who is a very successful cyber investor, was the CEO of Palo Alto, COO and president of Zscaler, and Guy Caspi, who's the founder and was at the IDF, and is just him and his team, him and his co-founders are amazing. It was hard to say no to, having listened to Sarah's advice about how you pick the company that you ultimately want to go to.
Yeah. And it's exciting. It's also scary because you pick what it might be one of the world's biggest problems right now. It's like the new threat to the new world that we're in is this what the next war looks like? Is it a data and cyber war? And like, are we at the very beginning of that? And I guess I'll ask you the same question that Jim had asked Lane is deep learning, is that the answer? Can this help stop what's happening? That's affecting everybody, not just technology, not just software and internet and security. It's affecting everyone. Entire municipalities are getting shut down, pipelines, gas. I mean, the list goes on.
This is a board level conversation, whoever you talk to. When we're talking to customers, Lane and Debbie serve on numerous other boards. Ray Chang, one of our other board members, he's a VC. I mean, this is impacting everybody. I mean, you see President Biden talking about cybersecurity. Look, this is a war. If you were to ask Guy, our co-founder and CEO, he would say, absolutely, this is a war that is not going to stop. And we have to do a better job protecting ourselves. I mean, especially when you think about the critical infrastructure that this could impact. I mean, whether or not it's water supply down in Florida, right? There was that earlier in the year. I mean, these are just going to keep on coming. And, there was, like you said, there was one this weekend. We all need to do a better job of protecting ourselves. And, that's the message we're trying to send to people is we're part of the solution. But, on one hand, it's unfortunate because it's going to be a growth market for a long time. Cybersecurity, if you go back over the last 20 years, has been the number one IT spending priority of every CIO survey I've done at whatever firm I've been at. It's been the number one priority. It's going to be the number one priority, maybe forever.
Yeah.
So
is this happening? Was COVID a catalyst? I mean, obviously, cyber has been the number one spend for CISOs for 20 plus years, but is it distributed workforces? Is it connectivity? Is it IoT? Social engineering and crypto? What's the cause of this boom that we're seeing? And unfortunately, where are the opportunities for the hackers? Is it on
it's all of the above, right? Like you mentioned it, it's the fact that we're all working in distributed environments, right? Even if we go back to 3 to 4 days a week in the office, right? Some companies do that. Some companies might go to 5. It's going to be hybrid. And if it's going to be hybrid, that means you've got endpoints that are not on what you used to go to work. You would log on to your corporate network and your IT people knew that you were kind of safe and sound, tucked away into this environment that they could monitor. You're not there anymore. You might be at your house today. You might be traveling in a hotel room and you're exposed. You might be working from a Starbucks, right? So you're now more exposed than you were before. That's one. You've got more devices. You've got printers. You're now connecting you connect to a printer at home. That's another. Think of all the endpoints that you're touching. Again, that aren't part of the network that used to be. And then you think of the fact that, you've also got IoT has been exploding. And it's not just IoT. Think about what the world's going to look like. I mean, I've always been, we used to do a lot of work on augmented and virtual reality, but think of augmented reality. If you were to talk to people about where the future of tech is going, are we going to be holding these, rectangular bricks in our hands 5 years from now? Or are we going to be wearing glasses that we're going to be able to see instead of looking down, see directions overlaid? All of those become, you might carry your phone plus that, right? Plus your glasses, that might be your connectivity device. That becomes an IoT device that also is a potential source of entry for a bad actor. So the number of vectors that people can enter in is only going to continue to explode. Think of self-driving cars.
Robots, autonomous vehicles, self-driving tractors on farms.
All of these need to be protected, right? And they're all, unfortunately, going to be areas of risk unless we solve this problem. And again, we're all thankful. There's a lot of great companies that are working on these types of problems. We think we're one of them that's going to help solve these, but these are really big challenges that are ahead of us.
Yeah. And so what's the correlation between like zero trust, which is like seems to be the number one thing on Gartner's radar and everyone's talking about it, like Biden's talking about it, and like what Deep Instinct's doing in the deep learning space?
So for us, it's about stopping things. Again, I'll go back to stopping pre-execution. You need to be able to detect these zero-day attacks. And there's a big difference. It's subtle, but big differences between how deep learning models are created and machine learning models are created. So we don't have manual intervention. Our models train themselves. With machine learning, one of the challenges with machine learning is that you need to have people responsible for the machine learning interpret. They have to pick out what's important and what pixels, let's just say, they want to pull out to emphasize. And so there's more human judgment, if you will. And by design, human judgment isn't always the best thing that you want because it could be based on your past experience, what you decide to emphasize versus not emphasize. With deep learning, we take away that because our models train themselves on all of the data. And so there's no human bias, if you will, on what the interpretation is. And, again, there's not that many people in the world that can do this. So this is very hard talent to attract and to retain. We are doing a good job of it, but that's what it's about. It's about making our models be self-learning. I'll give you the best example that might be easier for people to understand. Yahoo dominated the search market in the early 2000s, and they lost that lead to Google. Yahoo, if you know about how search engines were created, they manually indexed the web. I mean, when you think about it now, it's crazy that they did that, but they did. In the early days, they were doing manual indexing. Google created a deep learning algorithm and it indexed the web itself. So they trained it to index the web. That's what we're doing with these security models. So we can take these data sets and find the similarities or the derivants that are needed to be able to find and block that zero-day threat while others necessarily can't. So hopefully that gives some context.
No, that's super helpful. So I read that there's only like 7 or 8 companies in the world that have deep learning capability end-to-end in production. And it's a group of like Google, Apple, Facebook, IBM, and deep instinct is one of them.
Yes, we believe we are one of them for sure.
That's fantastic. And one last question. What has this transition been like for you from Goldman to, running 1 million miles a minute in a startup? A very important one, but still, like, is your head spinning? Was it what you expected?
You know what? It's been a great transition. So, for the last 20 years, I had been, if you were kind of waiting in line to get into a club, let's just say, and there's a velvet rope, and I was never getting into the club, right, with the velvet rope. You'd maybe try and ask the bouncer to let you in, they'd say no. So my face was pressed against the glass of the tech industry for years. And it was always really intriguing, and I loved that role. But after a while, you start yearning to be a part of it and see what life would be like when you can get to the other side of the velvet rope, if you will. And so, I was very thankful for the opportunity to be able to join the company. From a transition perspective, yeah, it's really busy, but it's been great. And what's been really fascinating to me is to take all the pattern recognition that I was able to develop over the last 20 years and the last 10 I was at Goldman, and be able to apply it to Deep Instinct and how we might be able to use some of that knowledge of how other companies saw their growth curves, what impacted their growth curves, what metrics should we be solving for. That's been really interesting and fascinating to me to be able to bring to the table and learn from, and to be able to actually solve problems that drive an outcome for a business instead of giving, advice that, the management team might be like, oh, what do they know? They've never worked in I remember Safra Katz one time, and she's now the CEO of Oracle, but she said to me, she's like, Heather, your spreadsheet and your model for Oracle is just numbers in a spreadsheet. And she's right. Like I always say, you're absolutely right. I don't have your model. Well, now I'm her. I have that model. And she would say, she's like, I've got the data that drives the numbers in your spreadsheet, meaning she could move the levers. And so it's been really interesting to actually now experience that on this side and kind of understanding truly, what she was referring to at the time. And she's obviously been massively successful. But so it's been a really fun process. We actually just ended up closing, you mentioned the Series D, 100 million from BlackRock. We just took on an additional 40 million from Chrysalis, which is a part of Jupiter Investments, which is based out of the UK, NASDAQ traded asset management company. So that happened at the same time as we closed our D. They came in and asked to get involved, and so we were able to extend the round even more. So I would say the time I've been here so far, I've been fundraising the entire time. This last 40 million kind of was more just by accident, if you will, than us actively looking for that money. But yeah, no, it's been great, and I would say it's been really. I mean, the board's fantastic, but also I would say, the founder, Guy Caspi, deserves a ton of credit, and he's been really helpful and, kind of taken me under his wing to teach me a lot that I didn't know. I still have a ton more, obviously, to learn and will be forever learning. But he's patient and gracious and, willing to let me run with things. So,
well, welcome to the club. The tech industry is thrilled to have you. And I really appreciate your time today. This has been amazing to catch up with you. It's been a couple months. And so I'm glad you're doing well. And I have some of that same feeling, like you're doing, what we do is we are headhunters for some of the best technology companies in the world. And so sometimes getting a glimpse of what it's like to actually be on one of those executive teams and getting to be able to reap the rewards of this crazy market that we're in. I think you made an amazing decision, not just from a company perspective, from an industry perspective, and just the leap of faith to go do something like this yourself. And so you got some really great advice. Thanks again for the time, and this has been amazing and super helpful. And thanks a lot.
Thank you, Frank. Appreciate it.
Thanks for listening to Dare to Be Legendary, brought to you by Diversa Partners. Feel free to check out the show notes for resources that we've mentioned throughout the episode. If you like what you heard, don't forget to subscribe, share with friends, and leave us a review. This helps us get content to more listeners like you. Thanks again, and stay tuned for our next episode.